Welcome, everyone. I'm Angelo Robles, to Angelo Robles' Effective Family Office podcast, where I look to distill the best practices and best ideas of the world's most successful families and their family offices. I hope to provide thought-provoking opinions and feature amazing thought leaders to our listeners of the podcast with an eye towards the future of the family office. Today's podcast is titled Renowned Angel Investor, Jason Calacanis, Everything You Wanted to Know About Investing in Startups. It features, obviously from that title, we have a special guest when their name makes the title. So we have Jason Calacanis, who's an angel investor and podcaster. Since I see that Jason uses that, and by the way, hello, Jason, I start to use podcaster in my title now. Thank you.
Thanks for having me. Yeah, podcasting is a wonderful medium. Well, you get to talk for a long time, and really, there's no time limit. And as opposed to when we're on something like CNBC or in a tweet, you get this very short, concise answer, which has its value in the world. Podcasts let you just really open up the conversation. I think that's why people are moving towards them and embracing them.
I started doing them 2 years ago, but really like Joe Rogan 3 to 4 days a week since COVID-19. I haven't missed a beat in 10 weeks, and I'm really liking it. Now, let's hope, Jason, you're a couple of notches ahead of me because of who you are. We hope we both, like Rogan, get a Spotify $100 million contract.
Yeah, I think it's a great thing that the talent in podcasting is getting recognized. When I'm on CNBC, I reach, I think 100,000 people, 200,000 people, and it's a really great audience. With my podcast, I get over 200,000 people each one, and that's my tribe, right? So I think what people are starting to realize is, Joe Rogan gets 10 million people on some of these episodes watching. Certainly he gets in the low millions, I think, every single episode, and that is the future, and he gets numbers that are similar to certainly MSNBC, Rachel Maddow, or Anderson Cooper. I think those all get 1, 2, 3 million, and so being on a Joe Rogan for a politician is going to be a bigger impact than being, in fact, on, MSNBC or CNN, which is crazy to think about. I started my podcast 11 years ago, 12 years ago, done over 1,000 episodes. There's 6 or 7 full-time people who work on it. And I don't do it for the money. I do it to meet founders and to build our funnel, in terms of investing. It's the top of the funnel for us. People hear me on the podcast. They hear me interview a great VC, angel, or founder. And then I say, hey, if you have a company and you'd like to come to our accelerator, you'd like for me to invest, just email me, jason@calacanis.com. And people stop me on the street to tell me about their startup. So it's just top of the
Yeah, it helps because you do the video as well as I do. And yeah, that does help a little bit with that. To give people a little bit of context, I've known about Jason for many years. I love his book, a big fan. A mutual acquaintance, some of you know, Bryant Hayward, had a chance to introduce us. Jason was kind enough to be one of the keynote speakers at a big event I hosted last summer. Those were the good old days of doing physical events on the waterfront in Santa Monica. He also appeared at about that same time on a podcast. I don't want to repeat exactly what we did in that podcast. Jason's background in Brooklyn, we caught up on pizza. Those are all great things. But again, you can listen to that podcast from last summer. We will touch a little bit upon Uber because that's such a great story. And Jason really is, with all due respect to the legends of earlier startup investing, the Ron Conways, the Dave McClures and others, Jason really is kind of the man. He's going to be a little modest, but when it comes to investing in earliest stage startups, we're really excited to have Jason on the show. I could go on for 2 or 3 hours. We're going to have a strict limit today of an hour. Jason has a very busy schedule. You mentioned your TV appearance, which I did see, and that prompted me to actually, why don't I lead with that question? Because you went off. And we have more than 7 or 8 minutes, so go off. You went off on a combination of California, regulation, taxes, and to some degree, the Bay Area, now with COVID-19, now with overly expensive real estate, and people realizing that remote working for white-collar workers works. Where do I start? Is California in trouble? Is Silicon Valley going to be the Silicon Valley that we know in 5 years?
Yeah, it's a great question. And I can tell you what I'm seeing on the front lines. And the front lines, every company that I've invested in is changing their work from home policy. Now, startups, um, typically 5 to 10% of them were 100% remote. And I would say the other 90% might have a remote worker here or there, but they had an in-office culture and they wanted to work on that culture and build that culture because it leads to an edge in terms of competing. So I don't believe an Uber or a Facebook or a Twitter or any of these companies could hit the scale they did without being in an office with people collaborating and that culture. It remains to be seen the size and the scope of the wins from work from home companies. We do have anecdotally a WordPress, which is worth $1 billion. Can a company that's worth 100 billion or 50 billion or 500 billion be built work from home? That's, I don't think, realistic, but I do think many people will be embracing this, and then you do get this massive benefit. And what people are not understanding is the economics, right? And incentives and economics really drive everything in this world. We all know that if you're in the capital game in any way, as somebody who is responsible for capital, as I am, and is placing bets like I am on a very frequent basis. When you think about capital allocation and when you think about what's going on here in terms of incentives, what do you gain by not having to be in the Bay Area? Well, Bay Area salaries are inflated because the average home, the average apartment, living expense is going to be 2 to 3x other cities. And it might be 5x living in a rural place. So going and living in Tahoe, which a lot of people from San Francisco have chosen to do, or Sacramento, your 2-bedroom apartment is now going to cost $1,000 a month, not $5,000, an 80% reduction. And so people are now taking advantage of that because they can. And then if you think about commercial real estate, we were kind of living off this 150 square feet, 250 square feet per employee. Now with Twitter and Square and other companies saying, listen, you don't need to come to the office anymore, we're permanent work from home, or Facebook saying half the people will be work from home. That means the number 2 or 3 line item, which is facilities
Sure.
and food in those facilities, goes away. So those companies become 20% more profitable, 10, 20, 30% more profitable, right? By removing that last expense. Now, if people work from home, the other thing that happens is you realize these 3 or 4 people are performing at a very high level, and these 2 or 3 people are not actually getting anything done. In an office, you can kind of hide because you're there and you're physically present, and they see you at your keyboard typing, and managers kind of step back and say, that person put in a good day's work. They were here for 10 hours. They were here for 12 hours. They were first one in, last one to leave. What happens when you move remote is people send a little stand up in the morning. They say, this is what I'm going to get done today. At the end of the day, they say an end of day report in their Slack room, or they do a meeting.
Mm-hmm.
Now people are realizing, wait a second, I'm looking at what this person got done today and what they said they were going to get done today, and that's actually not moving the needle. So that's part of the bottom 5% or 10% or 15% of the company that doesn't actually need to be here. And they're not actually performing. So people are going to be much more apt to cut those positions. Then when they rehire for them, they're going to remove the I would say $20,000 to $50,000 premium people got paid to work out of the Bay Area. And so the developer job that might have been $175K now becomes $125K. The sales executive who was getting paid $100K base and $100K in commissions, that base goes down to 50 and the commissions go down to 75. And in recognition of this, the only person who's cutthroat enough to even recognize that this nuance is happening, that this will ultimately make companies more profitable, is Zuckerberg. And Zuckerberg said, we're going to let 50%, up to 50% of, I think, positions are going to be able to go remote. However, if you leave San Francisco, you have to tell us where you're going to be working from, and we're going to adjust your salary down to that location because San Francisco is the highest. So those people who choose to leave and not come to the office anymore are going to get a pay cut starting January 1st. And there'll be severe ramifications for lying about where you live. So, 8 people are not going to rent a condo and say they live there and get the San Francisco thing. So I think this will actually be what leads us out of the recession, because it's always that efficiency or new products or services that lead us out of the recession, whether it's an iPhone or a Tesla, or Disney buying Marvel, all of those new innovative products create monetary velocity which then spreads money around and creates economic opportunity. So I think the economic opportunity that will come out of this tremendous implosion that we've had with 30, 40 million people being unemployed is that the companies are going to become wildly efficient. They're going to
Right.
remove 30, 40, 50% of expenses in some cases. Well, what does that do for profitability? It's going to skyrocket. And then it's also going to allow them to invest more in other places. So people who are shutting their facilities down, maybe next year they don't renew their lease. I know companies that aren't doing the releases, or they were month to month, and they just handed the keys back. Okay, well, all of a sudden you got $50,000 a month, $100,000 a month, $20,000 a month in additional money to spend. You hire 2 more people. So that's what's going to happen. I believe the work from home and the efficiency of that is going to lead us out of this terrible recession we're going into.
That would be very optimistic, and certainly some aspects of that I would agree with. San Francisco and your old hometown, New York, I find very intriguing. New York more so because of the volume of people here, but they're concentrated, relatively smaller geographic cities. They're very popular tourist destinations, and New York specifically has great mass transit, all negatives via COVID-19. Commercial real estate, for the reasons you noted, is going to be impacted. And I know you're not a real estate investor, so it's a strange question, but it popped in my head. Why buy high and sell low? The opportunity potentially to buy or to move into New York to San Francisco is when it appears to be on this trend, but it has enough good metrics where in 3, 5, 7, 10 years, you're going to see an upward trend. Potentially, we could finally buy in New York and not pay crazy prices. This might be a little bit of a return to the 70s or 80s in New York before it's bounced back. What do you think?
Yeah, I think that's probably directionally correct. There is a kind of standoff that occurs in real estate where the sellers have to accept the new reality and the buyers have to wait for the sellers to kind of reach down there. And so, somebody who bought a home in Manhattan for $3 million might not be apt to sell it for $2 million or $2.5 million, but the buyers don't want to pay that. And so you always hear from brokers that they're trying to get everybody to reality, and it takes time. What will not take time is commercial. So I think we're going to see commercial collapse and go down at least 50% because people are not going to want to go to an office. It's going to be very hard to compete for employees if your competitors are offering work from home, which is the number one thing employees want. The number one thing employees want is that flexibility to either come to the office or not. And so if you don't offer it, you might not be able to compete for the best talent. That doesn't mean people don't want to come to the office, but they may want to come to the office from 10 to 4 and miss traffic. They might want to come in Tuesday, Wednesday, Thursday, and have Friday and Monday to work from home. So I think that commercial gets crushed. And then in areas where they've been pro-development, so New York has been wildly pro-development for decades in terms of apartments and building these high-end units. Well, those high-end units will come down in price. Affluent people will buy those, and it will take the pressure off the inventory from the 50s, 60s, and 70s, and those apartments that maybe weren't as modern, have smaller windows and weird floor plans. And that will give a new opportunity for people to move into Manhattan. And then this beautiful cycle will start again of young, energetic people being able to live in cities again. San Francisco has been anti-development. And so you have not been able to build homes here. The NIMBYism, not in my backyard, phenomenon in San Francisco and NorCal is unlike anything I've ever seen. If you try to build any kind of a building, you're going to be in for a decade-long fight. Whereas in New York or Houston or other cities, they've been really pro-development and trying to push things through. So I don't see the Bay Area changing as the hub, but I do see, and I don't see residential crashing here. I think it will correct, but not crash. But I do see universally office space will crash. And if you have money and office space, we all knew it was, kind of looking frothy there. And now I just think a lot of the landlords are going to be handing their properties back to the banks, right? All those people who are flipping buildings and then, taking the money out and then buying another building. All my friends who were doing that, they were telling me last year or the year before that they were concerned. And now you have the black swan event of black swan events that's going to just murder those companies.
I know it's not the kind of companies you invest in, but I want to get your opinion. It's a little sad, at least going through in my car in New York, and seeing all these, like 90% of the businesses are small businesses. Let's really be honest, for all the reasons I noted, and the fact that many of them don't have a lot of savings. 25 to 40% of these small businesses are going to be out. It just feels terrible.
Yeah.
And I don't know, they're an entrepreneur in their own way. They just don't necessarily build tech companies or companies that in theory could scale, but that doesn't mean that they don't have a spirit inside them, that they don't provide wonderful services to the economy. What would you say to them in terms of needing to start from scratch and rebuild and start over again? Because if they just go back to a lease they can't afford at a restaurant at 40% capacity, the math is not even going to come close to working.
It's going to be a severe challenge for small businesses. I'm hoping that landlords are reasonable and they don't want to see those storefronts, in the case of restaurants, go empty for a long time. And so I think they're going to the landlords are going to have to negotiate with the banks that they owe money to say, listen, I'm going to have to give this restaurant, I'm going to renegotiate the lease. And so it's just going to be this great unwinding where, and I'm seeing it already, if you have a long-term lease, maybe you're just shut of the business and start again next year if you think it's going to be better and start a new lease. If your landlord's willing to play ball and give you 50% rent for the rest of 2020 and then, maybe 75% rent in 2021, maybe those businesses survive. But it's that's the thing. I'm super concerned, I'll be totally honest, that this bifurcation has happened. Anything in the real world is going to be severely crippled, and then anything behind a keyboard could even be accelerated. So in our portfolio,
Right.
we kind of bucket things into three groups. We have companies that have literally doubled their usage and revenue during the pandemic. So just let that sink in. A company that in February was doing X dollar amount is now doing X times 2. And then we have companies that were doing X in January and February that are doing literally 0. And it's really challenging as an investor doing this triage in your portfolio where you have one group of founders who are basically furloughing everybody and another group who are saying, should we be hiring people now? Is this going to be sustained? Should we be raising money into this? And so people are going to be very confused watching the behavior in Silicon Valley. And what you're going to see is intelligent investors are going to be investing during this period of time. I believe this is the best opportunity to be an angel investor or to be investing in private companies in our lifetimes, second only maybe to after the financial crisis or after the dot-com bust. But I have a feeling this one might be even better. When I made all my great investments, they were in the years during the Great Recession when Uber was worth $5 million and Calm was worth $5 million and Thumbtack was worth $4 million. I mean, I invested in those three companies for, I think, a $14 or $15 million valuation combined. And the last 2 or 3 years, companies with less performance than those coming out of YC or other accelerators were asking for 12 or 15 or $20 million valuations. In other words, I could invest in 3 Ubers or Thumbtacks or Calms for the price that people with less performance were asking for over the last couple of years. Entry price matters when you're angel investing. And it doesn't matter because, hey, if you hit a $10 billion company, does it matter if you invested at 5, 10, or 15? Well, sure, it matters, but you're happy to have hit that outlier.
Yeah.
The reason it actually matters is shots on goal. If I have a certain amount of capital to deploy and it's costing me $100 million to invest in this company, I'm putting $1 million in and I'm getting 1% of the company. Well, I can invest in 10 companies, $100,000, get 10 swings at bat, and still spend the same amount of money and still have the same percentage ownership. And I try to explain this to founders and to new investors. Be valuation conscious. It actually matters your entry point. And a lot of people in the public markets are going to learn this because maybe they bought momentum stocks that now the momentum's gone. Oh my Lord, they're never going to catch up to where the momentum was, right? And so it's a very nuanced thing, but we're investing more going into the crisis than we were before.
There's an amazing creative spirit that happens during crises from really all sorts of people. And again, many great companies have been founded during crisis, henceforth an opportunity for investors, whether directly or through someone like you or others, to be involved. So you just said, and you gave some reasons why, as to why right now may be an incredible time to be active as an earlier stage investor. Now, we all know the math. For every block of 10 companies I invest in, most won't make it. And these are the pros, people like you. As a family office, how do I think that I'm going to get in early enough just because I have money? That helps. And how am I going to have enough diversity to get some big winners?
This is absolutely something that you have to think about as a family office. What I see with family offices typically is they will get the deal flow after it's passed through Silicon Valley. So I just want to
Yes.
pause on that for a second. This would be like if a bunch of poker players were at a table and there were 10 of us, and the family offices were 3 people at the end. And Y Combinator, Launch Accelerator, you know, Bill Gurley at Benchmark, et cetera. We've all looked at these deals. We looked at those whole cards and we said, you know what? Don't want to play 10-7. Don't want to play 3-8 offsuit. I'm going to pass those cards down. And then we see, oh, ace king. Oh, we see queens. Oh, we see kings. Oh, okay, we're going to play those cards. Oh, we're going to play king, queen suited. And we're playing the premium hands, and then you're getting the non-premium hands. And this is not meant as an insult. It is meant as the reality of having an edge in investing. I cannot compete with high frequency traders. I don't know how to make a high frequency trade. I don't know how to do puts and calls and spreads. That is not what I do for a living. I am in a different world and I need to have a different edge. My edge is to meet the founder first and to be the most helpful to them and then introduce them to the most helpful people downstream. So I want to get my company in front of Sequoia, in front of Benchmark, and have them join the team and we both work on it together. Now, I don't try to have an edge in public market investing. I put everything when I'm in a public market in my Wealthfront account on a very balanced low fee setting, because I know for me to compete in that public market, I'm not beating the high frequency traders. It's going to be about me lowering what the vig I have to pay, right? What percentage I'm paying to a fund manager. And if I can get into those Vanguard funds that are just unbelievably low fees, that's what I want to do. But in private market investing, I want to have an edge. Now, if you are a family office, people in the entrepreneurial community say, I would like to get a family office because I want an investor who is not valuation sensitive. That's what they say to me. And I say to them, okay, so what you're saying is you want an investor who's not smart. That's how entrepreneurs look at family offices. They look at it as dumb money. Now, that doesn't mean it's true, but that is something to consider. That if they're looking at it saying, you know what, I'm not going to clear market at this valuation, but a family office might jump the fence and do it. Just understand, everybody has their level of expertise. What a family office may be very good at is preserving wealth and managing many categories of investments, from real estate to resources, to startups, to venture, to private equity, and maintaining the wealth of that family for generations. That is a different mission statement. So whenever I see family offices want to get into individual company investing, I really tell them, make sure that this company has not been passed on by everybody else, because then you're just trying to split the arrow. Like, you're trying to really make something work that's going to be challenged. And it's better to align yourself with fund managers who know what they're doing, and then maybe see if they'll give you their allocation for pro rata down the future, or just invest in companies that have revenue, right? And try to get an allocation in a later round where they have revenue, and you don't need to be on top of it. I need to be really on top of the early stage companies. I need to be in constant contact with them, monthly contact with them, weekly, quarterly. When you are investing in the later stage, you can kind of invest and check in with the founder every 6 to 12 months, right? They've already got 10 million in revenue. They've already got 50 million in revenue. That's where I would advise family offices. That would be a sweet spot. If you can get into venture deals when they have 10 to 50 million in revenue, you're like way before the IPO, but you're after the world I live in, which is 80% go to zero. You really don't want to be investing in that world unless you want to really roll up your sleeves and you want to be involved on a very detailed level and deal with a lot of mortality. It's pretty depressing for most people. Their brain psychology can't deal with 80% of bets losing. Imagine you bought 10 publicly traded stocks. You bought Disney, Netflix, Google, Amazon, and like 3 out of 4 went out of business. You'd be like, what just happened? Well, that's my life. That's literally my life. 3 out of 4, zero. And a lot of pain and suffering to get to zero. And then 1 out of 30 being an outlier, 1 out of 40 being an outlier. That's really what's going on here in Silicon Valley. And if you're just honest about that, then you can really free yourself and be more humble about what it takes to win. What it takes to win is being able to have proprietary deal flow, make a lot of bets, identify which ones are breaking out, and then 10xing down on them. That's what I've spent the last 5 years learning how to do.
Do you
First
think
5
that
years,
those pro rata rights are really important?
they're critical. And, because when you have a winner with Uber and, other companies that I invested in when I was an early angel investor, putting in 25 or 50K, I never even thought about pro rata. Now I have pro rata in a deal or I don't do it. And when we're looking at our portfolio and we examine their revenue and we try to get their monthly revenue, their quarterly revenue. And then I have somebody on my team who's looking at which of our 150 active companies who made 250 investments in the last decade or so, of the 150 active ones, which ones had the greatest quarter over quarter, year over year performance? And are they looking to raise money? And we make preemptive offers to them. And so we've had maybe a half dozen companies in the last year or so that we've said, hey, great job. Would you like an extra 250K? Would you like an extra $1 million? And they say, no, I want to go to the market. I want to see what valuation I get. Say, okay, but we'll give you $1 million at a $15 million cap. Would you like $1 million? We'd like to own 7% more of the business, 8% more of the business, whatever it is. And I'm happy to report, I think, 4 out of 5 times, 80% of the time, we wind up getting that deal. So we're preemptively funding our own winners. Then we move from, a 6% ownership percentage to a 12 to 20% ownership percentage. And that to us is, in my early days, I owned under 1%, obviously, of Uber. But then with Superhuman, we owned 2%. With Calm, we owned 5 or 6%. And now with this latest crop of winners, Fitbod, Steezy, we're starting to own 9, 10, 15%. And that's why, the next 10 years for me as an angel investor, instead of just being, this amazing angel who happened to hit an outlier, people are going to look at me and say, oh, he's a fund manager who figured out how to get 5% of Calm, when nobody else would invest. Okay, he figured out how to get 12% or 9% of Steezy or Fitbod before anybody realized these were breakout companies. So that's what I'm really working on now.
Now, could I make the point of what you said, that it would be possible for a family that's big enough and has the money and has the fortitude for it, as opposed to looking to fit a square peg in a round hole and have their current people become experts in startups? Could they find a young Jason Calacanis before you become who you are and woo them with salary, bonus, and I have a lot of money to spend, and you're not going to need investors. I'm your investor. I'm going to take care of it for you.
I see very little downside to that. I think even just for the intelligence, let's say you had a 200, I don't know what the average family office size is, but pick a number. And if they were putting 1% of the fund to work every year for 5 years, and they put 5% of the fund to work, and it was a $100 million family office, and they put $5 million to work over 5 years, if they even returned half of that money, or they just broke even, all of that intelligence and knowledge about where the market is going, with the outside chance of hitting a home run, would be well worth it. It's one of the things that I think people don't understand about this business, is that if you are making these bets and you just break even or lose a little bit of money, the chances of being in the game to hit an outlier are so dramatic that it's worth doing. So I would say yes. I mean, if that person cost you $100,000 a year, $150,000 a year, and they just brought you, 50 great ideas a year, one a week, and you invested in the top 5 of those, 200K, that could be a nice portfolio that could be built. But what's more important is the intelligence you would be getting. You would know the future because you'd have those 50 deal memos coming to you, and you would be picking the top 5. Just think about the knowledge your organization would have when that associate or principal was bringing that company a week to them that they wanted to invest in. The whole company would get smarter. So you would be able to make a better bet on Disney knowing about streaming services 10 years ago, right? You'd be able to make a better bet on Hertz knowing about what Uber and Lyft were doing 10 years ago. You can make a better bet on JP Morgan, Goldman Sachs, or E-Trade knowing what Robinhood was doing 5 years ago. So that's what I love about what I do every day. That's why I'm so attracted to the early stage. It's because I get to see the future 10 years before y'all. I mean, it's a wonderful, brilliant career to have, knowing where the future is going.
Let's talk a little bit about the origins of the industry, probably more so in VC, but go back to what, 1958, 1959. And ironically, with Silicon Valley, not a lot of innovation. And then you did have something come along that you're going to be very familiar with. But talk about how it did change the game a little bit, and that would be AngelList.
Yeah, AngelList was an incredible innovation. I was the first syndicate on AngelList. So when Naval launched it, I
Mhm.
was doing something called Open Angel Forum. He was doing something called Venture Hacks. So it's a little
That's
bit of a
right.
history story. So Venture Hacks, Naval's an introvert, really smart. I'm an extrovert and more of a hustler. Let's leave it at that. Uh, I would host an in-person event that he would come to, and I would have 6 startups pitch. Uber and Thumbtack and StyleSeat were some of the ones who did, in fact, pitch. And he would be there, and he was doing VentureList, where he would take the same companies, or he would introduce me to companies, because there really weren't that many. It'd be like 1 new company a week, 2 new companies a week back in the day. And he would email everybody and say, "Hey, check these out." And then he started making content about how to read a term sheet, all the stuff that people didn't know 12 years ago or so. He said, "I'm going to take what you're doing, I'm going to move it online." And I was like, "Okay, I'll be part of that. Seems like a good idea." And so, that was his real big contribution. Then he started doing these SPVs. And so I became the largest syndicate on the platform. I wound up leaving after about 40 or 50 investments. We can get into that and why. But my first investment was com.com. And we put $378,000 into it. And that company went from being worth 5 million to 1.4 billion. And so that position, depending on where you would value the stock, is a 200x investment, right? So if you put in 5,000, you're going to get back 1 million. And we actually sold 10% of our shares when it hit a $250 million valuation. In secondary, we booked a 3.x win for the syndicate in like under 5 years, cash on cash, while still owning 90% of our shares. And so that's just a great outcome. And it's brilliant what he did. We wound up creating thesyndicate.com so that we could have control over our experience. We could have a direct relationship with those investors. And we have the top 10% of the syndicate, top 250 of them in a Slack instance right now. And they're helping us work on projects. So I've activated the syndicate. What AngelList does is they don't want the syndicate members to be involved with the companies, really.
Right.
They are steering people towards funds. So why are they steering people towards funds? Well, if you get the diversification. I'm doing the opposite. I'm telling people, read my book, angelthebook.com, Angel. And for 12 bucks or whatever it costs on Audible, you can hear me read it. You're going to learn some stuff about angel investing, all the mistakes I made. Then watch my podcast, This Week in Startups, or angelpodcast.com, and learn how to be a picker. Because I think learning how to pick individual stocks in the public market or learning how to pick individual companies in the private market is really the reason to do it, because it's fun and it's educational and you get to hang out with the smartest, most driven people in the world. Those reasons alone are a reason to do it. The fact that you could hit an outlier and hit a life-changing home run, even more reason to do it. And so we've done, I think, 130 deals. And the first deal we ever did, I think, would return the entire portfolio, which is the power law of all of this. And so I have been teaching a course, Angel.University, while in quarantine. And the first one had 150 people come, then 250, then 150. Then I'm doing it next month, another 200. And we put all of that, we asked people to make a donation of $100 to charity, and I teach it for 3 hours. And I think we've raised $50,000 or $60,000 for COVID
Nice.
charities, which we gave away on Twitter. You can watch me doing it. We gave it to the frontline workers. We fed an ICU for a week, 2 meals a day in Brooklyn, my hometown. And it's been wonderful. And I think that's what people are learning about this time is, if 100% of people have set up their cameras and set up their Ethernet, and you and I are doing this now, we've all embraced it. Now the whole world can participate. And that really is the vision for I'm 49 years old. I'm going into the last kind of chapter of my career. I want to build a syndicate of 10,000 active members. I'm at 4,000 members now, of which 2,000 are active. And I want to get to 10,000 because I want to be able to fund a company with $10 million from 250 people for $40,000 each, and boom, be able to do a Series A or Series B funding. That's my dream. And I want to inspire all of these affluent, rich people who are bored, who have already made their money, to join me in the greatest career that you could ever have for an affluent person, which is meeting the smartest people in the world when they're 25 or 35 years old and starting this company. Sometimes it happens with 40 and 50-year-olds, not as much. But You get to hang out with a bunch of young people or young at heart people who want to change the world and want to steer the arc of humanity towards something amazing, a better future. And it's just the thrill of a lifetime to invest in those companies.
Yeah, actually, after this next question, I've had multiple entrepreneurs say, yeah, I know you're going to be more focused on investing in family offices, but I love for you, and I will ask some questions from their perspective, which will be good insight for the investors and families in terms of how you help to identify what we hope is going to be a winner and advice you would have. But my first question, we didn't completely dive quite into enough. I think it needs a little more. And that basically is the US is dominant in the startup community, but more so even in VC. That's where, on the investing side, we really shine. You got Silicon Valley, New York, Boston, LA, San Diego, Austin, a little bit of Miami, Boulder, Seattle, Portland. So you got various communities, but California, mainly the Bay Area, really, quote unquote, dominates. Do you think that we could be losing a little bit of an edge to what the number 2, 3, and 4 players are? I'm going to take a guess. China, Israel. I mean, they're probably way behind us, but is it great that we have people coming to our universities, getting educated, not staying here and taking their knowledge and their entrepreneurial spirit back to, let's say, China and creating great companies there?
Yeah, I mean, China, we could do an entire podcast on. I have very strong feelings about it. I have always been a hawk about, supporting or becoming dependent on communist countries, authoritarian countries, and the ones that do not support basic human rights. I believe that the United States' role and our best selves is when we are the champions of human rights and the champions of justice in the world. And I believe capitalism plus justice, democracy, is the greatest operating system for humanity that we've discovered to date. I believe that in my heart. I believe that capitalism plus democracy plus justice equals the best human condition. That does not mean that there are not issues in our country. We have the death penalty. We tortured people. We created, Gitmo. I mean, we make mistakes. We do bad things. We waterboarded people. We should not have done that. This is not comparable to the policies of Saudi Arabia or China or North Korea. These are places where people are murdered, re-educated, put in concentration camps. This is a different level of sadistic dominance of the human spirit. And we have to make a decision as a country. Do we want to make an incremental 10 or 20% in our companies by pandering to a communist country that tortures and imprisons its own citizens for reading books or practicing religion? Or do we want to give up that 10 or 20% and keep our morals and ethics and be able to sleep at night? And I really think we need to choose the latter. And that's what I think is getting lost in this discussion, is a very basic concept. Do the people of Hong Kong get to decide their future? Do the people of Taiwan get to decide their future? Do they get to be free people? And the answer in Hong Kong is no. They're losing their freedom, and you're going to see millions of people be absorbed by a communist country. And we have to decide, do we want the world to become authoritarian, and do we want the majority of people living in the world to live under communism or authoritarianism, or do we want them to live under democracies? And it's a very serious issue, and capitalism is the key linchpin in it.
Mm-hmm.
We have to be dominant in creating great companies. We have to make the world's best products, and if they want to participate in our market, in our free market, there is a price to be paid. If China wants TikTok here, if they want Huawei, if they want to go public on our stock markets, they're going to have to improve their human rights. And we have the right, as a sovereign country, to say, we want to participate in your market if you participate in ours. And if you don't let us have Instagram and Twitter and Google in China, you don't get to have TikTok in the United States. And I think the person who went to go work for TikTok who's an American is a traitor. That's how I feel. Going to work for a country that, a company based in a communist country, I think you're a traitor. I think you have to have your head examined, right? And I wouldn't do it. That's just my morals and my ethics. Other people want to make a lot of money, and TikTok's going to make a lot of money. But TikTok is, a company that's run out of a communist country, and you can be certain that if there is anybody who needs to be turned over to the Communist Party in China, that TikTok will do it in an instant. And that person who left Disney to go work there is going to have blood on their hands when they hand over freedom fighters, dissidents, and religious leaders to the Communist Party. Not that I have firm
Incredibly,
opinions on
incredibly well said. I completely concur. Again, I did promise the entrepreneurs we'd get to some things for then.
it.
For
Sure.
them, I'll try to do it a little quickly in round robin. You get a deck. It's not 20 years ago of a 75-page business plan. Is it one page, two page? Do you get a slide PDF format, 10 or 15 slides? It seems like simpler is better. What do you like to see?
Yeah. So for me, I am trying to make a decision on your potential based on your performance. So let me just unpack that. I want to try to figure out if you have the potential to build a company that gets to 50 to 100 million in revenue. What's the best way for me to do that? Well, the best way for me to do it is look at your performance. And so looking at their performance, I would want to know, is this performance great enough? And are they committed enough to take more capital, and have they earned that right in the competition? And this is critical. They are in a competition. It is a zero-sum game. And one of the problems with this country is that we've told the generation that it's not a zero-sum game. It is a zero-sum game for capital. If I make an investment in your company, that means another company doesn't get that check. That's not me being, like some hard ass. That's just reality. There's only so many checks each person can write, whether it's Sequoia, or Goldman Sachs or TPG. We all have a certain pool of capital, and you're in competition to win that capital. So if it is a competition, then performance is paramount. What do you look for in performance? You look for customers. So if you're a family office and you're trying to figure out, is this a company I should invest in? The number one thing you should do that you are not doing, and you're not doing it, let's be honest, is to talk to customers of that product. And you need to ask them, what would you do if this product went away? And if they say, I'd be upset. Okay. But if they said, wait, is the product going away? Because can I get a license to the software? I'll pay you 10,000 because this is mission critical for us. Or if they say, oh, I'd be bummed. Like, this is two levels of, product market fit. You need to talk to the customers. You need to study the data, but it doesn't need to be a lot. And so founders are selecting for charisma. Founders are incredibly charismatic people. And what we are trying to do is take those incredibly charismatic people and figure out, with this incredibly charismatic person, are they full of shit, pardon my French, or are they actually a high performer? And man, if you just listen to them, there are some people who could spin a heck of a yarn. And what you need to do is take the yarn that they spin, put it over here as a checkbox for, this person is charismatic. This person is convincing. That's important. What's more important is that their customer loves their product.
And okay, so now you meet them, or in the old world you meet them, maybe you meet them via Zoom. Do you think after you know the math and metrics from looking at their deck, whatever, within 5 or 10 minutes, you got to feel whether they have it or not?
Yeah, I mean, I like to think that my superpower is the ability to read people. That's why I put myself at the early stage. I like to read people. I like to look in their eyes, and I listen very intently, and I ask them very pointed questions to try to figure out if this is legit or not. So one of the questions I've asked is there some other idea you have that's better than this one? And I ask that not to be a jerk, but I've had people say, yeah, like I have another company I'm working on the side. And I'm like, okay, why are we even talking about this, right? And you'll be surprised that, or you ask somebody like, why did you pick business to business? Isn't this really a consumer service? Shouldn't you be doing a consumer service? And they'll say to you, oh, do you think so? Will you invest if I make it a consumer service? Okay. It's like, I like to look for somebody who has some craftsmanship. I don't know the gender neutral word for craftsmanship, but they're a craftsperson. Sounds a little weird, but craftsperson, we'll go with it. Are they a craftsperson? When they make something, is there craftsmanship to it? Does it have a certain thoughtfulness to it, in the way an iPhone or a Tesla does, in the way Calm did, or the way Robinhood did, or the way Uber did? I can see it in the product. And if I can see it in the product, I can see that level of detail. I know the other customers can too. So I'm really a product guy. I feel like I can read the person, but you have to remember, these are highly charismatic people who will pull the wool over your eyes. If you're just going based on their charisma, you're not getting a 360-degree view. Their charisma, their product, their customers. This is what really ultimately matters. Are they charismatic enough to get customers and get employees and get investment, but is the product so good? Does the product have charisma? Does the product draw people in? And do those people not shut up about the product? That's really what you're looking for.
I'm seeing a question come in that I am going to read. Jason, do you see whether the VC space should or could be disrupted? Now, we spoke a little bit about AngelList, or is the current model copacetic as is, whether during or after COVID-19?
Yeah, there's nothing wrong with the venture capital model. I mean, people like to attack it. They like to point out the absurdity of it. And it's very easy to point out the absurdity of people who invest in 10 companies with full knowledge of 6, 7, or 8 of them going to zero, depending on the stage you're in. So it looks like a crazy, cowboy kind of approach. And it is. And that's the strength of it, is that we say yes to crazy ideas and we give them millions of dollars. We call them experiments here. That forgives you from making a bad bet. I did an experiment. I spent $3 million seeing if this company could do X. I spent $5 million seeing if the company could do Y, knowing that if it did work, it would be 500X my investment. That is a risk worth taking if you have the bankroll to do 100, 200, 300 investments. And so that's, I think, just the reality of what we do. There's nothing broken about venture capital. It's a really great system. There are flaws to it. We can list them all. But overall, venture capital has created the greatest innovations of the last 50 years almost universally. I mean, once in a while, you'll have somebody create something in government. Obviously, the internet was created by the government. And so people like to point to that, and GPS. And there's a fair point. But without venture capitalists saying, hey, let's build Uber based on GPS, or let's build Google based upon the internet, you wouldn't have that commercialization, and you wouldn't have all those downstream businesses that were created. You look at something like an eBay, you look at something like Shopify, Squarespace, the amount of business those businesses creates a violent entrepreneurial capitalism that just creates more and more businesses, more and more opportunities and jobs. And that's why our little country of 300 million punches above its weight, is because of our entrepreneurial and risk-taking spirit. Venture capital is a key piece of that. And what venture capitalists have done is, because they have so much money, they've kind of moved a bit downstream, and they've said, you know what, for the apple orchard where you're picking the apples, Y Combinator, seed funds, AngelList, Republic, Seed Invest, all these platforms, all these accelerators, they can take over that piece.
And actually related a little bit to that, a successful entrepreneur effectively wanted me to ask you, and they're an entrepreneur from really never went to college, blue collar type industries, but they bring up some decent points. Basically, Jason, what advice would you have to someone, they're not a techie, they're not going to build $100 million or $1 billion company. They're going to look at opportunity in distressed areas and potentially put laundry mats there or this or that. How come people can't take a dry industry like that and scale it up to some level? Again, it's probably never going to be the monster, but again, what guidance or advice would you give to that entrepreneur? Before you answer that, someone did go on video. We're recording this. If you could pop your video off, I'd appreciate it. Thank you very much. Thank you. Go for it, Jason.
Yeah, I mean, listen, people conflate venture capitalists' indifference to moderate growth companies as an insult. And what they should conflate it with is, this group of people is trying to put satellites in space. They're not trying to take people on a flight across the country. When you try to get a satellite to space, you use a rocket and a lot of fuel, and they blow up frequently. And when you try to take a flight on Southwest, you're trying to do it or Ryanair, you're trying to get the lowest possible price, the most safety, and you're optimizing for something completely different. You're not optimizing for going Mach whatever. You're optimizing for safety. You're optimizing for cost. That's a different model than what VCs are looking for. In order to take this risk of 7 of 10 going to zero, you would need to take so many risks at the rocket ship blowing up that it wouldn't be palatable for pizzerias or dry cleaners or people making, jackets or something. Those businesses are going to grow 10% a year, and in, 7 years or 7.2 years, they're going to double. And that's going to be awesome for the founder. And venture capitalists call that a lifestyle business. That's not an insult. What it means when they say a lifestyle business, and it's been often misunderstood as a derogatory, insulting term. What they're saying is you're going to have a sick lifestyle. Your lifestyle is going to be awesome. You're going to grow this business 10 to 20% a year. Every 3 to 7 years, it's going to double in size. You own 100% of it, and all those profits are going to go into your pocket every year. When you make $1 million in profit, every year you get that $1 million, and you still own the business, all the shares, so you can still sell it. Congratulations on an amazing lifestyle that you now have.
There was a couple of points I was going to bring up in Jason's book, which I highly recommend. And he, to some degree, already touched on them. He basically has 4 key points. 1, you want to make 30 plus investments so you have a chance of an outlier. And he did talk about that in the podcast today. 2, you want to only invest in startups that have products in market and revenue already. And there are thousands of them. 3, you want to make very small bets when you start and then go 2, 10x on the winners. And these are all things that Jason spoke about. I know it sounds logical. Many of them are going to fail. You need diversity. But when you see them starting to win, that's when you want to, multiply your bet down. And he states you want to make these 30 plus investments over a 3-year period. Perhaps don't be in a rush to get them all done in 2 or 3 months. You're going to learn along the way. I mean, I just find Jason's story about knowing Travis from Uber and identifying that opportunity that many, many people in Jason's situation looked at and said, come on, this is, what is this? There's cabs. Why is this needed? It's just basically, it's a technology play. And, that ended up being, I guess, his all-time great investment, although certainly Colm and some of the others have done incredibly well. But I just love Jason, his background from Brooklyn, so the New York thing. We could catch up on pizzerias. That's always fun. And, like he said, Naval at AngelList is this brilliant intellectual. And, Jason's a tough kid, of Greek heritage from Brooklyn. We're always smarter than maybe we let to the outside world, us from that kind of background. So I could certainly relate to Jason. But I think even if we don't get him back, we were about ready to wrap up in a couple of minutes. I absolutely recommend that you have a chance to learn more about Jason, to potentially be involved in what he's doing. And again, in anything in investing, never invest more than you could lose. Investing in startups is incredibly, incredibly risky. I mean, these are the pros. Look how talented Jason is. And look at what he does in terms of understanding the decks and the entrepreneur and the idea and is it making money. And even then, the vast majority, especially earlier stage, just won't make it. And look at the VC firms where they even have more insight from the startups, already having some success, yet a lot of them are not going to be the grand slams and make it either. It's really, really, really hard to be an entrepreneur. It's hard to be an investor in these kind of industries. And that's what Jason was noting even for family offices that have the money. It's a really hard business to compete with the professionals. You may not like 2 and 20 where that's applicable, but there are times when that simply is absolutely the way to go. And for you to build an internal team, that's not going to be free. That's going to cost money, and they still have to compete with the professionals. Now, I thought that my idea that, how do you identify a young Jason Calacanis and bring them on and give them a good part of the action probably would be the way for a significant family office to go if they wanted to be more active directly as an investor, and realize even compensating Jason in his younger days, eventually he's probably going to want to go out on his own. And like a lot of legendary hedge fund managers have done, you can't stifle that. You thank them for the time you had with them. You potentially have an agreement where you're able to invest in what they're doing in their company, and you're able to walk away on good terms. From my experiences with families that are seeders and early adopters and alternatives, that is likely the approach that I would take. We're just about the top of the hour. Unfortunately, it doesn't look like we're going to get Jason back. I recommend you listen to the first podcast I did with him last July, if I remember correctly. So, probably a good 40, 50 episodes ago. We go much, much deeper into the Uber story and all these great stories that Jason has. But I felt it would be great to bring him on. We'd like to have him on much more frequently. I thought he was a great guest and so much more that we left on the table, where there'll be a next Google, a next amazing company coming out of COVID-19, what he's seeing with entrepreneurs, what's happening with AI, with machine learning, with VR. I would have liked to have asked him that. We'll save that for the next time. And a little bit of the dark side of what some of that will bring to blue collar workers and how that could be a challenge and ways that we could potentially address that. So yeah, working from home and remote has been great for many people in the white collar industries, but that really isn't going to be an option in a lot of blue collar industries. So there's some grave concerns here. Jason, I think you might be back.
I'm back. We lost our internet in San Francisco, but we rebooted the routers and we came back. Sorry, it took a minute.
I was waxing poetically about you.
Oh,
Well, let's ask you some of the questions while we probably just have a couple of minutes of your time. Sure. What I was talking about is through the crisis of COVID and creativity, will there be amazing companies in AI, machine learning, VR? VR has lagged a little bit to what we hoped it would be, and it does make working remotely not quite as personal, yet I'm feeling in the next year or two that's going to radically change. Are we about to be, and I think you believe so from what you said, at the early stages of what could be the next wave of great companies to come?
Yeah, people tend to, I think, overestimate technologies in the short term and underestimate them in the long term. Somebody credited with that expression. I can't remember who said it first, but it's one of those expressions that everybody here says. And VR is probably one of those technologies where, my gosh, since the 80s, into the 90s, 2000s, 2010.
Always disappointed.
It's always universally disappointed. And today, I put them on and I'm absolutely amazed at the fidelity, but I get motion sickness. And then what I realized is video, which we were told, hey, you will, remember the old AT&T commercials, you will be doing video conferencing with your family. Like that is now a reality. And video conferencing existed in the 80s. And now here we are, 90s, 2000, 30 years later, video technology actually works flawlessly. And what we're doing right now used to take a Cisco $250,000 dedicated room with a satellite uplink. And now it works over the internet for free. And everybody's got a webcam built into their laptop. Zoom is free up to 40 minutes. You get the idea. So given all of this, I think it is, probably another 10 or 20 years until VR actually has the Zoom moment that Zoom is having right now. I used to love GoToMeeting. For some reason, GoToMeeting was too complex for people and Cisco maybe was too expensive. But I used to use GoToMeeting all the time. I loved it. But Zoom was just like, here's a URL, pop up the room. You don't need to have anything else, right? They kind of stripped it down and made it easy to use. And this is what we call the consumerization of the enterprise, where enterprise software is made as easy as, a consumer app like Uber or, as easy as Sonos. So Zoom is as easy to use as Spotify. Slack is as easy to use as Spotify or Uber. That's really what's happening, is that consumerization of the enterprise. I'm not a huge fan of VR. I think AR is going to be more interesting, to be honest. But who knows? Like I said, people tend to underestimate it. I went to a real world VR center over last Thanksgiving with the family, where you play in a group, where you all put on backpacks and had VR headsets and you shoot zombies. And it was the most fun time I've had in a long time. So I think like the in-person VR stuff, like the gaming, is just really fun to do in an amusement park kind of way. So it's open-ended. We'll see about VR. I think AR is the big winner. I think that's why Apple pushed all their chips into augmented reality. So glasses that will put, your name or your latest tweet above your head, or above my head. It will put, I don't know how many angel investments I've done. Like if we were all on AngelList, it would show our AngelList stats above our heads.
Yeah, I mean, the amazing thing about these technology driven companies, even a company like Zoom, but going back to truly iconic companies, how we use Apple, Google, is lost a little bit in the irony is how easy they are to use. It needs to be convenient, even Uber, etc. It's not like we need to have a PhD or be a techie ourselves. That's very nichey, and there may be good opportunities for that as applicable. But generally, what's going to have the mass appeal to the masses is going to be something that people could use and utilize very easy.
Yeah, the bottom up sales of enterprise software is truly amazing. Like it used to be that a CTO would go golfing or to the Knicks game with the VP of sales, enterprise sales at some Oracle, or Cisco, and these like top down technology decisions would be made for a giant organization. When I started my career in IT at Sony, that's how it worked. We'd find out what software we were using when the CTO approved it. And then, this bottom up technology movement is what's really been compelling. Some organizations start using Notion, or they start using LinkedIn Jobs, or they start using Slack, or they, pick the bottom up software. Somebody uses Fiverr, in an organization, puts it on their corporate card. Then 50 people use Fiverr or Notion or Slack or GoToMeeting, whatever it is. And then somebody says, you know what, we have like 50 licenses of this. We should get like a site license, and we should get a discount, and we should train everybody. But that bottom up approach has led to lower costs initially, more, and it makes the software better, because if
For
people
sure.
unsubscribe at any point in time, that's the opposite of how licensing worked in the Microsoft and Oracle area. You would buy a 5-year license to Microsoft Office. You would buy a 10-year license to Oracle, or a 7-year license. They were selling long licenses, multi-million-dollar deals. Now people are like, I'm on Amazon Cloud Services, but you know what? I'm not happy. I'm going to Google Cloud. Google Cloud's not doing what I needed to do. They didn't pick up the phone. I'm going to go to Microsoft Azure. Like people are really, bouncing between the different services, and it makes everybody more focused and making better products, which is good for consumers, and businesses are consumers.
I mean, you certainly had it. I know we're going to be very tight for time, so we'll maybe get the 2-minute version, not the 20-minute like we did the first time. How you met Travis, the founder of Uber, and really one of the greatest investments of all time. You were investor number 3. What did you see in him?
Well, I had known Travis when I was a journalist.
Okay.
Where you host your events, that ballroom at Casa del Mar in Santa Monica on the ocean, that's actually the same ballroom where I interviewed him.
Oh my God.
And I used to do a CEO interview, and he was doing a company called Scour. He had just been sued for $1 trillion, $250 billion by Hollywood, because people were stealing movies on it. Scour was sort of like a Napster of its time, but it supported video files and PDFs and any file type. And, I was always good friends with him. I watched him build Red Swoosh. And when Uber came out, I was trying to be helpful in the ecosystem. People knew I was writing small angel checks. And he said, hey, can you help me? And I said, sure, let me introduce you to some investors. And I think 2 or 3 of the investors at the Open Angel Forum, which is now called remotedemoday.com. So if any investors want to come to remotedemoday.com, just go there and sign up. And we just have 7 companies. Some of them are ones I've already invested in. Some of them are just new ones. Share what they're working on. And if people are interested, they go invest. And that's really what I've learned in my career here is, if you just are a person who's helpful and you're helpful to everybody you meet, like many people in Silicon Valley were to me, and I probably wasn't the easiest person to be helpful to at times, you're going to have a great career. So I focus on just being super, super helpful to everybody. And that's, I think, how ultimately the Uber investment happened. Was I was just being helpful to a lot of people, and luck struck, and since then I've got lucky 12 times.
That's all. I think the last.
No, I sort of say that as a joke. People are just like, oh, you're just lucky. I'm just like, yeah, no, I agree. Lucky 12 times in 20 years. Sounds good. Every year or 2, I get lucky.
I'm going to take a question.
A lot of bets.
I'm going to take a question from a live listener, but reposition it a little bit. And basically, it's talking about what really could be what we would perceive as the future. And it may apply more to edtech and education. And that would be the advent of hologram for learning, of taking someone's voice, saying the right couple of pronunciations or words, and being able to create a whole vocabulary from that, Now, that could get a little eerie with a loved one that may have passed on, but I'm finding this intriguing. It reminds me, of course, of the Star Trek from the 80s with the hologram. Are we on the cusp of something amazing with this? And will this change education, or we're still 10, 20 years out?
Yeah, I think everybody's getting a fast forward view of the world because of the pandemic and being forced to stay at home. And one of the things that we're all having to deal with is, hey, the kids are home and they're having like a double or triple summer in some cases, and especially if your kids went to camp, you might have a week off and then they would start going to camp. The idea that they're home this whole time and then parents are responsible for educating them, people are starting to realize, wow, there's an opportunity here to make education better. And oh, wait a second, the work that they're actually doing is 2 hours a day. What's happening during the other 4 hours a day? Oh, socialization is happening and other things. And so I think you're going to see a homeschooling boom. People are finding resources like Khan Academy. We have an investment in a company called Brilliant.org, which is for high performers in physics and math, and they're doing tremendous business. And I think you're going to see this emergence of, call it $10 to $500 a month subscriptions to educational resources that give your child a better education than public school. And public school varies greatly, but it's very important. But I think what we'll find is for some kids, doing homeschooling is going to work better. And then people now, because they've been left to fend for themselves, I was talking to another set of parents and I said, I don't know what's going to happen in September, but if they're not going to go back to school, I'm going to hire a teacher. I'm going to hire the best teacher, have my 3 daughters go to that school in my living room or, find a space. And then I'll just invite 5 of my friends and maybe, 6 people, if there's 10 kids amongst them and we have 1 teacher for 10 kids or 2 teachers for 10 kids, we're just going to divide their salary by 10 or 5 or whatever it is. And it actually might equal the same as what we were paying for private school or something close to that. And so, Elon did that with his Ad Astra school. And, I think it worked out great for his kids and some other kids there. And so I think this, whatever was the sacred cow, whatever was the obvious choice is now no longer that. And college is the other one. Like, who's paying $50,000 in tuition to take Zoom classes in September? All the students I've talked to and all the parents I've talked to, they all say gap year next year. Everybody's taking a gap year and they're just telling schools I'm deferring. And then I see certain schools, I saw something about Berkeley was like, we're not making SATs or whatever they were, qualifiers anymore. So they basically said, you know what? We're going to open the aperture. We're going to let more people into schools. And there needs to be more competition. You can get an online education for a much better price than traditional college. And traditional college, as we've seen, in some cases is bought and paid for. And that maybe the admissions process is not exactly fair. I think that's being charitable.
Are we going to see tech companies align with universities and the dynamic of how we're educated in secondary education is going to change radically?
I think you're going to see a lot of the second tier, third tier schools just shutter, and they're going to put their campuses up for sale. And so I've been waiting for, a campus to open up for a school. And then I was going to move my founder university, Angel University, and my incubator to it. So I think, the idea that there are thousands of schools teaching the same math class or the same economics class when you could just have the greatest economics teacher do it over Zoom and have 1,000 students in it who then go into breakout groups, I think people are going to radically shuffle the deck. And if you look at a company like Masterclass, which I passed on investing in like an idiot, it's just so stupid. I mean, I just knew when I met David, the founder, that he was special, but I didn't get it. And I just, like an idiot, I convinced myself not to invest when I knew I should have. And that's just one of those things you get better at,
The reverse confirmation bias, so to speak.
You get zero credit for being like, majority chance this fails. It's like, yes, we just said in this conversation 10 times, the majority outcome for ambitious companies is failure. But don't stop betting. And, I think Masterclass, if you were looking to go to film school, the 100th best film school, maybe taking all the master classes, maybe hiring a video editing tutor, and maybe spending $10,000 on your first short would cost you $30,000 total over 2 years.
But
college might cost you $100 and you go into debt. So I like the idea of rethinking this whole education process.
Oh, completely. But is it acceptable not to have a paper, a diploma on your wall, a degree?
100%. 100%. Now, I was talking to one of the most powerful CEOs in America, and we were just having lunch or dinner or something, I can't remember. And I said, did you hear about this kid who went to MIT? He took all the MIT courses in 18 months and documented it. And he basically did their online courseware and has all the documentation for it. And he's writing a book about how he did that. And he did it like in half the amount of time. And he scored in the top percentile because all of this stuff is online for free. I said, who would you rather hire? A person who did all that work from MIT on their own and did it in half the amount of time and never set foot on the MIT campus, or somebody who graduated from MIT? And the person was like, well, obviously the one who had the chutzpah and the drive to do it from home. So that example is incredibly illustrative of how entrepreneurs think. We want the underdog, grinder, hardworking person who hacked the system more than we want the person whose parents photoshopped them on a rowing equipment to try to get them in. We all know it's a game. We all know that certain people are getting, into these, doctored places because of money. It's obvious to everybody. It's always been that way. What we want is the people who can actually perform. And companies are no longer looking for a Harvard degree or a Columbia degree or an NYU degree or whatever great school it is as the lead for hiring a person. Almost universally, when I talk to startups, they're saying, I need somebody who can solve this problem with this skill. So I tell young people, what are your skills? And they're like, I have a business degree. I'm like, not a skill. Do you have a skill of creating pivot tables in spreadsheets and building models? And they're like, well, I kind of used it. It's like, are you an expert on it? Rate your skill on a scale of 1 to 10 at how good you are at spreadsheets. Oh, you're a 6? The world does not need you. Oh, you're an 8? The world might tolerate you. Oh, you're a 9 or 10? Now you're going to be employable forever. And so young people need to realize it's all going to be skill-based. The idea that the degree is going to save you is over. That's over. And it's actually been over for a long time. People are hiring based on skill. They're based on motivation, how hardworking the person is, how clever they are. They're not basing it on what used to be the proxy, which was that Harvard magically took a smart person and made them smarter. Harvard's taking smart people and not making them dumb. That's really what they're doing. If Harvard had the formula to make dumb people smart, there would be 1,000 Harvard campuses. Harvards would be Starbucks. And everybody who went to Starbucks would get 10 IQ points. That's not what's happening here, people. They're taking already smart people in a competition for a limited number of seats to get the most storied degree, the most beautiful logo, the most impressive logo for your LinkedIn page, and they're just selling that. They're not selling that fact and that doesn't mean that you don't have a great experience if you go there. I'm sure you do. But they haven't actually cracked the nut of making brilliant leaders. Let's be honest. They've identified brilliant leaders and not fucked it up. That's cynical. Sorry for the Harvard MBAs and who are 200K in debt.
No, I'm glad.
Just good at picking. They're good at picking, just like I am. It's not that I'm making the startups I invest in 10x more effective. I might make them 10% more effective, but I'm not making them 10x more effective. I might give them 10 times the number of introductions. That might save them 6 months, and that's important. But I do not think that I invest in Travis and his performance goes up. I identify that Travis is a high performer. I'm lucky enough to invest, and maybe I help him get a couple of investors and get through a certain acute problem he's got at the moment. And maybe I'm a good person to have a conversational with Travis when he wants to discuss surge pricing, which we did back in the day. But that's about it. I think a lot of times investors want to take credit. I want to give a high five. I'm proud of the companies I invest in, but I in no way think that I made those companies or I did what the founder did. I'm along for the ride. I am there to high five. I'm part of the entourage. I'm lucky to be on the ride with them. And yeah, on the margins, I can help them. But let's be real,
Well, it's a very humble approach, and it served you well. For those in the audience, whether live or hearing it on a podcast or a video, that would like to learn more about what you do, how could they do that?
Yeah, so number one, read the book or listen to it. Number two, my podcast is free.
The book name, Jason?
Angel is the book. You can go to angelthebook.com, or you can just type Angel Jason Calacanis into Google. You'll find it. I like the audio book a lot. More people, I think the audio book outsells the actual print one, because I speak it, and people, when you're a podcaster, they like that. Second, I have Angel.University, which is a course that I teach basically for a donation to charity. And I go into 3 hours into detail how I make investment decisions. And it's kind of based on the book. And I do it monthly. So there's a June date out there. You can sign up right now. And if the June is filled up, you can sign up for July. Angel.University. And then I'm Jason on Twitter. So twitter.com/Jason, and Instagram.com/Jason, and Tumblr, jason.tumblr.com. So, and Calacanis.com. And my email is jason@Calacanis. And if you can't find me, then you don't know how to use the internet.
Yeah, it's probably.
Get Startups is my podcast.
Wow, that was fantastic. I'm glad we covered so much, and still a lot of things left unanswered for the next time. I am going to have to do about a 2-minute wrap up. If you're in a rush, Jason, feel free to exit out.
And just thanks for including me, and Angelo, you've been very nice of just including me in like everything you do, and that really means a lot to me. So, and you do a high-class job of like putting these things together, and it's, just as one content producer and event producer to another, I just really respect the work you're doing, and I appreciate you including me.
Well, thank you. Coming from you, that means a lot to me. I appreciate that, Jason. Thank you so much.
Everybody stay safe, okay?
You too. And everyone, I am Angelo Robles. I'm the host of Angelo Robles' Effective Family Office podcast. Now, besides being, of course, on Apple, Stitcher, and others, finally, I'm on Spotify. So if that's a better platform for you, feel free to look me up on there. I'm the founder and CEO at Family Office Association, a global membership organization dedicated to families of great success and their single-family office executives. We do a significant amount of proprietary original content, and during COVID-19, I don't know if I've ever been this creative. A fair amount of it I haven't released yet. It's upcoming in June into July, and relates a lot of it to masterclasses, ironically, although from a different perspective, what Jason brought up. Yes, we host a lot of events. I've had amazing speakers like Jason, and at that same event, we had people like Tony Robbins that spoke, and in the past, Ray Dalio, and so many others. Now, during COVID, of course, that's going to be on hold for a while, but we're active with our online meetings every day, doing videos every day, doing mastermind with family to family, usually at least once a week, launching our online platform, and launching a whole bunch of member services, some of it consultative, that we're really excited about. So we're adapting. We're being very, very active during this time. I thank my members for their support. And if you're a family of wealth and resources, or a family office that would like to be more active and get the full breadth of our membership and relationship at FOA, join, become a part of it. We'll have a brand new, beautiful website in about 1 or 2 more weeks. So those of you hearing this on a podcast will be able to see that, and it'll be easier than ever to interact and be a part of the organization. I, too, am very active on social media, Family Office Association on Instagram, Angelo Robles and Family Office Association on LinkedIn. And really, I highly recommend my YouTube channel, where a lot of these videos are shown after the fact. And that is simply Family Office. So I'm pretty easy to find on YouTube as well. You could also reach me at FamilyOfficeAssociation.com, AngelORobles.com, and preferred email, Angelo@FamilyOfficeAssociation.com. Thank you all so much for listening in live. Thank you for my audience in YouTube and our podcast channels as well. And again, thank you to Jason Calacanis, who simply is the best. It was great to have him on today. Until next time, everyone have a great day.